Big news coming out of massive layoffs across the country that has totaled just shy of 5 million people in the last 3 months alone. Now, the Federal Reserve is about to stop shrinking its balance sheet, and it has been all but promising to cut interest rates and completely flipping the script since 2022. Now, for a lot of people, this sounds like a lot of business as usual banker talk. But if you invest in real estate, businesses, or want to own a home, this could be the single biggest turning point since 2020. Now, in today's video, I'll break down what's happening, why it matters, how it actually works, and how it could change real estate investing for the next few years. All right, so here's the story. Since 2022, the Feds have been doing something called quantitative tightening, basically shrinking its massive $9 trillion balance sheet by letting bonds and mortgage-backed securities expire instead of buying new ones. Now, they've already drained about $2.4 trillion out of the system over the last 2.5 years, and now we're starting to see small cracks, some large cracks in the economy. Banks are already borrowing billions from the Fed's emergency lending facility. Money markets are tightening, and analysts are saying that liquidity is drying up. In short, the Fed might be done tightening. They're signaling that the end of the quantitative tightening is near and that rate cuts could be coming very soon. So imagine the entire economy as a giant fish tank full of money. The Federal Reserve, the Fed, controls the hose that fills the tank. When things go bad, like during the pandemic, they turn this hose on full blast. Water, or money, floods into the system. Banks lend freely, businesses grow, and people buy houses and basically everything else. Inflation. That's called printing money, or quantitative easing, QE. But when the bank gets too full, prices start to rise. That's inflation. So the Fed turns off the hose and sometimes even lets some of the water drain out, like what's happening right now. That's quantitative tightening, or QT. Money leaving the system so that borrowing gets harder and interest rates rise. The problem now is the tank's running a little low on water, and banks, or the fish, and the loans are starting to get nervous and drying up. And the economy's starting to feel a little bit strained. So the Fed's about to turn the hose back on just a little bit, not to flood it like before, but just enough to keep the fish alive. That's what people mean when they say the Fed is ending QT or cutting rates. More water in the tank equals more liquidity, which means easier lending. And that is when investors like us will start moving again. And you should care because this is all happening behind the curtains of everything that occurs from borrowing, building, or investing. When the Fed drains money, borrowing gets harder, loans get pricier, and property values tend to flatten, sometimes even fall. Exactly like what we've all experienced the last few years. It's also why we saw inflation get curbed from its peak in 2022. Now, when they add money, it's the opposite effect, also known as increasing their balance sheet. Liquidity returns, interest rates ease, and assets like real estate starts to move up again, exactly like what we saw between 2020 and 2022. Now, the Fed has already hinted at a possible 25 basis point rate cut, aiming for its benchmark interest rate in the 3.75 to 4% range. And if the tightening ends at the same time, we could see a double boost: cheaper short-term borrowing, think credit cards, and then lower long-term rates like mortgages. So what does this all mean for you as an investor? If the Fed stops draining money and starts cutting rates, that means mortgage rates could fall, more than likely. Construction loans get cheaper, cap rates get compressed, meaning that property and business values will increase, and deals that didn't make sense 6 months ago will most likely start penciling again. But, and this is important, if liquidity stays tight, the Fed does not turn on the hose, that rate relief could take a little bit longer to hit your local market. Either way, this is the moment to start stress testing your portfolio and options to purchase. You're going to want to ask yourself a couple of key questions. What happens if rates drop 1%? When should I consider refinancing? What can I do now to be ready to buy before asset prices go up? Here's what I'd be doing right now. Review your underwriting, plug in new rate assumptions, and see what that does to your cash flows, or what we call pre-tax profits. You can download and get our investment unit economics sheet here that we use all the time. Link is down below when you join our free community. You can also refinance strategically if it saves you cash or extends your runway. Start tracking deals that went cold. I would also highly recommend staying liquid. Even if rates drop, lenders move slow and cash still is king. And watch for momentum. Once the Fed flips the switch, investor sentiment changes fast. Typically, it lags behind a couple to several months, but if you wait until everyone realizes the pivot's happening, it's probably already too late for you. Rates will be low, and thus buyers will flood the market, and then asset prices will climb, which is also good for investors. So the Fed isn't just talking about interest rates this time. They're finally about to change the flow of money that fuels the entire financial system of the US economy. When they stop draining and start refilling, the liquidity is going to return. The cash is going to come back into the economy. And every real estate cycle, every boom and every bust starts with that moment. I'm Kai Andrew. Subscribe if you want to stay ahead of the next wave, and I'll see you in the next current event.